our preferred approach for the married put structure, as discussed in the blueprint, also has a preferred search. We don't call it a picks of the day, but the fusion trades that are posted in radioactive trading following the blueprint, 95, probably 99% of them come directly from this default search. Radioactive sorted by earnings per share growth. This is the default criteria that is discussed in the blueprint, where we're looking for positions that are at least 150 to 900 days out of time, controlling the risk between 3.5% and 9.5%, single-digit risks. We might elevate a discussion into that as to why that is important. I know you know why it's important, but when you actually see the mathematics of it, it stands out a lot more. We don't want to go more than 20% in the money, because now we're sort of canceling the expectancy of profit by going too deep in the money with the puts. We want a nice controlled risk. And we're following the basic stock criteria, where we are looking at a specific company list, but we're limiting it to certain ranges of stocks, must be in an uptrend, have some volatility, don't want to see something too low, good average stock volume, and a positive earnings per share growth. So again, 95%, 97% of the trades posted in the Fusion portfolio at RadioActiveTrading.com, where Ernie and I post our married put trades and the income methods we use, come directly from this list. Why am I going into this detail? David had just asked, what strike and date do you select when using a protective put? Well, number one, David, as discussed in the blueprint, it's not etched in stone. You can see here that there's preferred criteria that we're using. 150 to 900 days out in time, not going more than 20% in the money, keeping the risk controlled to single digits. Not going more than a few strikes in the money, because as I mentioned, that deters the expectancy. Now, when you look at one of these positions, you might say, oh, well, that's really expensive, and you're still taking a relatively high risk for something that's adding a lot of capital into the position. Well, let's talk about that. Let's just take our first one. It's on Shopify. Stock's at 76.82, and we're shown that we can buy the January 90 put, almost 400 days out in time, midpoint of 21.03. Well, if I pay 76.82 for the stock, and I did have to pay the full ask price of 21.40 for the put, I'd have a total cost basis of 98.22. Remember, I'm guaranteed to get 90 back, so the max risk is only 8.22, but this represents 8.4% of the total cost basis. Why would I take a position trading at 76.82? Add to the cost basis, where now we can say my total net debit is 98.22, so my break even is 98.22, which is 12 points almost. The cost of the time value of the put is 8.22 really. But why am I adding to this cost basis? I'm sorry, 22 points roughly, as you can see, 21.40. Why am I adding that much and increasing my break even to where I can't make a profit until the stock's above 98.22? Well, this is the total net debit, which is the break even of this married put position. Only at expiration, 400 days away, not tomorrow, not 10 days from now, not 90 days from now, not 240 days from now, 400 days from now. Let's take a look at the profit and loss chart here in Power Options from that default married put search. And here we have our Shopify married put position. And what you're looking at here is the blue hockey stick graph, naturally, is the profit and loss chart at expiration. January 2025, 399 days away. At midpoint price, we'd have an even risk of about 8%, David. But again, that's only realized if we hold the position all the way to expiration 400 days from now. Make no adjustments on the position. Accept no dividends if Shopify pays a dividend. And the stock's trading below $90. Then we'd have the full loss of 8% on the position. But that's not what we're looking to do with the married put position. As you see here, the curved red line, this is the profit and loss chart expected around July 3rd, halfway between now and expiration. And as we can see here, the break even is closer to about 82, maybe 83, probably closer to 84 in this case, David. but it's not at the 98.22 or the 97.84 at midpoint break-even price. That's only at expiration. So although the puts looks expensive, you get what you pay for. And we're going to illustrate that in just a moment as well. Shorter term, of course, if I said, what if the stock moves up to, let's just say $78 in the next week or two? Just take it out to December 28th, 13 days away. Well, see now, the curved red line follows what we'd expect to see on December 28th. We see we're starting to hit a profit as low as $78.90. But the first break even, in this case, is probably really around 77 or so. And that's because when we open the position, the put doesn't go to zero. It's still going to retain a lot of its time value, 10, 15, 30 days from now, because we bought the proper put that was further out in time. As the stock moves up, we're not losing one-to-one with the put. We have a positive delta on this position. So even if I open this position today around these prices, and come Monday, Shopify is up to $77.82, it moves up $1, I'd still have a profit of 50 cents on the position, even though I'm nowhere near that 98.22 or 97.84 if we get filled at midpoint. The preferred married put structure takes advantage of the three core principles of radioactive trading, which really applies to any trading. And as you know, number one, we want to force an ideal size trade. So there's two levels of protection that we discuss in the full course, the blueprint for the married put approach with the 13 different income methods. So the fist position, force ideal size trade. Sorry, folks. There we go. So sometimes just referred to as fist. And what's that telling us is we want to control the risk to single digits. What's the point of using protection if you're not still taking risk of 20, 25, 30%? So that's number one. But what I'm also going to do is a second layer of protection. And this is discussed in the first few chapters of the blueprint. I'm kind of giving a little bit away here, but not really. What I mean by that is that how do I determine, now that I've decided this is the stock that I want to do, how am I going to determine how many shares or how many put contracts I'm going to buy? And that's going to be determined by the 1 to 2% rule. And what I mean by that is the mathematical risk here, if I was filled at midpoint, is $784.50. I want to make sure that every married put I open only represents between 1 to 2% of my total portfolio value. So if I had a $50,000 account and I only wanted to risk 2% of my total portfolio, the max in this position, this dictates to me that with this risk of $784, so this would be $1,000, I'm only going to be opening 100 shares and one put. Now, the next trade I select from that list might only be a $32 stock, purchasing a $35 put for the same risk of 6, 7, or 8%, David. But because the risk might only be around 345, I might do 300 shares of that next position, because now I'd be under the $1,000 with, say, a $900, $960 risk, depending on what the monetary risk was. So that's the second layer of protection. I'm forcing an ideal size trade. So even if I'm wrong on this position, it completely falls out of bed against me. Something comes up that I couldn't see in any of the data, news, stock technicals, stock fundamentals, the stock craters down to $45 or $50 per share, I might be at that 8% risk, but the monetary risk on my portfolio was only 1 or 2%. I can still handle that very easily and move on, keeping 98 to 99% of what I initially started off with in my portfolio, use that to go into new positions. So that's what we call one of the first three core principles is FIST, forcing an ideal size trade. And there's two functions discussed in the blueprint that do that. Number two, the at-the-money bell curve. Now, the at-the-money bell curve here, what does it tell us? We look at any option chain, and we're going to do some visit to an option chain for Shopify in just a moment to illustrate 2 points. But if you look at any option chain at any expiration date, the highest time value, not the highest premium, in the money is naturally going to have a higher cost because they're made of intrinsic and extrinsic, or time value. Now, the at the money swell will always have the highest time value or extrinsic value. So here we'd be talking about maybe the 77.50 or the 75. If Shopify offers weekly options, it'd probably be the 77 strike if they offer single digits. So what does that tell us? It tells us when I'm selling, I want to be selling right here at the peak. I want to maximize time premium. Yeah, maybe a little bit over here selling a call. I want to give myself a little bit of upward movement in that case. But again, I want to maximize the time value. I want to sell when time value is dear, and I want to buy where time value is lower. So the stock's trading here at 76.82. The in-the-money puts at the higher price are going to have lower time premium, only 6, 7, or 8%. Now, down, and that's in the money. The rest of that cost we're looking at, the rest of that $21 is the extrinsic value. Okay, and it looks expensive, and you could say, well, if I'm going up to 90, 14 points above, and paying this low time value you mentioned, why don't I go 14 points below, down to 64, 62, maybe 62.50, because the time value will be low here as well. Well, now you get what you pay for, meaning that in order for this protection to be worth anything, you might only be paying $785 for that put instead of the $21.02. But the stock needs to fall that 12, 13, or 14 points before the insurance kicks in. So you're losing the $12 and you're losing the time value, all extrinsic value, on that $785. So we want to be in the money here to maximize the insurance and be on the proper side of the ATM bell curve. We don't want to overpay into intrinsic value by buying right at the money. Once again, forcing an ideal size trade, and we quickly discussed the two ways to do that. Number 2, the ATM bell curve. In the blueprint, 2 might be 3 and 3 might be 2, but that's okay. So we're talking about that ATM bell curve. We want to sell dear and sell into the highest time value. We want to buy on the lower wings. And the third core principle, and now as you're seeing it, what does this also do, David? This applies to any options trade. Doing a credit spread that gives me leveraged positions, I don't want to jump in and do 100 contracts of something I'm pretty sure is going to work out, and I've got a 88, 87% probability, because if I'm wrong and it quickly moves against me for an unexpected reason, I could lose 100% of what I put up into that position, the margin requirement, the difference in the strike prices. Credit spreads should only represent 10 to 15% of my total portfolio because they can quickly lose 50% of what you put up for the trade if the market suddenly turns. The at the money bell curve, hey, you do covered calls, out of the money cash secured naked puts. You want to go out of the money with the cash secured put potentially because you want to have that higher probability of it expiring worthless. Same with the bull put credit spread. You don't want to go too far out of the money because there's no premium. You want to be at a good happy medium near the at the money, but with enough where you have a good delta, good probability of maybe it expiring worthless. If you're doing in the money covered calls, similar. But if you're doing covered calls, where you want to hold the stock long term and still generate income, you don't want to go 10 to 15% out of the money with a delta of 0.12 or 0.10 or a delta of 10 or 12 because there's no premium. You want to be closer in. You want 0.4, 0.3, somewhere in that range maybe. You still get a good premium, but still give you some upside where you think the stock might reach. Now, on that note with selling, credit spreads, cash secured naked puts, we know that when we're selling, we want to sell weekly or month by month to get a better annualized return. You get a higher annualized return when you sell week by week or sell month by month, as opposed to selling something that's 5 months out or 6 months out, which has a higher premium, but it's not 5 times the cost. In that sense, if I get a better annualized return, selling shorter term, 10, 15, 5 days out in time, and I don't get as high as an annualized return selling farther out in time, doesn't the reverse work the same with buying? When I'm buying call options, speculating on a movement of a stock, do I want to buy one that's 2 or 3 days out? No, I want to do something that's going to give me more time for the stock to move in my direction. Even though it's a higher cost, I'm saving money long term. So that's why we're selling the put 200, 300, 400 days out in time. This is the time decay curve, or the radioactive decay, because in those first couple months, I'm going to see a very slow time decay, and it's not going to kick in till the rapid time decay, the extrinsic value, my true risk on the position, until we get into those last 30 days, 45 days, 1 week, 2 weeks out in time. So buying for protection, forcing an ideal size trade, taking advantage of that at the money bell curve and the radioactive decay line, or the time decay curve. I want to be on the proper side here to see a slower time decay. I am looking for positions that I feel are going to increase in price, maybe in the next 20 to 30 to 40 days, expecting to see a move of 3 to 6%. As you can see, if that happens, I'm probably going to be on an unrealized profit on the position. I didn't need the stock to go up to this high value. That's only at expiration. This is the proper insurance. This is the proper protected positions that takes advantage of the 3 core principles, as I mentioned, of radioactive trading, but really apply to any options trade. Forcing an ideal size trade so you can't get hurt. 2 ways to do it discussed in the blueprint. It's not just about the monetary risk and the percentage risk on the individual trade, but the risk in your total portfolio. Following the ATM bell curve, we want to buy on the outer wings where the extrinsic value is lower, and putting time on our side with the time decay curve. Now, a question comes in, why don't you just use delta? Why don't you just use something else? What delta would you use for this? We don't. Because everything works hand in hand. If I'm searching for specific positions that match that specific criteria, controlling the risk to single digits, 8.5% to 3.5%, with that structure of not going too deep in the money or not buying out of the money positions, what do I end up with? Well, I end up with the proper risk that we wanted. And as you can see here, when I add the delta in, let me change this because it might be hard to see for a second. Hold on a moment. I have the delta here, but it's all the way at the end. So I'm going to change the column order here on the search. I'm going to select delta. We're going to move it right up to the maximum risk. Submit and save that. There we go. Now, normally what I do in these webinars, David, when I get to this point, I don't have delta selected. I'd go ahead and select it, and then immediately you can see it. Delta is not one of the filters we're using in this search. We have it available if you want to use it. Here's your delta that you can use for the delta of the put. But as I scroll back up, what do you see? On the first page, the first 15 of 26 results, the deltas are all in a range of, it looks like 0.44, minus 0.44 because we're talking about puts, to minus 0.53. Without using delta, because of the proper structure, I am actually sorting by delta. I am filtering by delta. That's a very tight window of only a 0.09 range of delta on the first page without even using it. Because we're looking for the proper structures of going slightly in the money to control risk to single digits. Verification of a few concepts that I just discussed here. First off, we talked about the ATM bell curve naturally. I just want to illustrate that. And we'll go to Shopify, and I'm going to go to the option chain. And let me go to a small chain just to keep it simple for now. Let's just go 30 days out in time. All right, let's go to standard January expiration, David. And what I want to look for here, let's see, do I have it? Yes, it's at the very end. So my very last column here for Shopify, well, the naked yield, if I sold this as a naked put, that's what I see, but the percent midpoint time value. You can also look at the monetary midpoint time value if you wanted to, David, but here, the percent midpoint time value. We're at 76.82. This is really bizarre. I guess when it gets up to that range, it doesn't allow single digit strikes offerings. It only does 2-point strike offsets above 75, it looks like. But we can see the same thing here. Let me clear that up. And let's go ahead and go here. Sorry, I need to scroll down a little bit. Now that we know what the column is, we know the stock's at 76.82. We're not seeing the 77 strike. There is an 81 though. That's very odd. It looks like the 77 hasn't been added. But in any case, what do we see here? Where's the highest time value? Right here at 76. It would be at 77. We'd probably be at 4% time premium if that 77 was showing up across the exchanges. 1 month out, the time value or extrinsic value of the out-of-the-money options, 0.3, 0.4, 0.5, starts increasing, 1.9, 2.7, 3.8, 3.5, and then we slip back down. That's the ATM Bell Curve in action. I don't want to be buying necessarily right here. I want to be buying here into the lower extrinsic value. But this is also a no-no. We're going to illustrate that in a moment. But it's the same for every expiration, naturally, David. And many of you may know this, but it never hurts to discuss it again. We are looking at January, 399 days out in time. We saw the 90 put. We only have 5-point strike differences. But what do we see in our time premium here? Where is the largest time premium? The 75 strike. As I go deeper out of the money, that goes lower and lower. And then as we go deeper in the money, that drops lower and lower. And there is that 95 we were talking about at 2103 midpoint. I'm sorry, the 90 at 2103 midpoint with a midpoint time value of 10.2%. The extrinsic value or the true risk on the position. That's the ATM Bell Curve. What else do we notice about this? Let me put a hold on January 2025. Let me go back to January 2024. Standard expiration. This is 35 days left to expiration. We were analyzing the 90 put, which has a cost basis of $13.40. Now, of course, the stock's at $76.82. That hasn't changed. So we're roughly $13.22 in the money. Time value is only 0.3% for 35 days out in time. Price is $13.40. So naturally, 35 days out, price is $13.40. If I go down to the 90 strike here, at 399 days left, it should be 10 times the cost. It's not even $10 the cost. It's $21.03. It's only $8 more for 10 times the amount of time. Okay, well, that's not a fair assessment because, you say, oh, well, you're looking at deep in the money. That 30-day out that's so deep in the money is such a low probability. Well, take a look at the at-the-monies. We have to use the 75s because 2025 only has the 75s available. 399 days out, the 75 put for Shopify is at 1245 midpoint. A factor of 10 less, the 75 is at 245. Which means what? For the next 400 days, 399 days, if I bought the at-the-money put, assuming IV remains the same, which we know it's not going to, and the stock price isn't going to remain the same, but assuming IV remain the same, even as the stock goes up and down, if I bought the at-the-money put 10 times, I just want to protect my Shopify position for a cheaper price, only $2.45 for the next 35 days. Okay, well, it didn't drop, it went up, so I lose the 245. So let me buy a February one. The stock's now at 80. Let me buy the 80 put for 245, 250. It goes up to 82, so I'm profiting, but I'm losing 245 each time. I do that 10 times. For the next 399 days, I've paid $24.50. Whereas if I just bought the 399 day out or 180 or 200 day out put option, I'm only paying $12.45. Almost half of what it would cost me to buy the at-the-money cheap put, lower cost put 10 times over the same time frame. That's our time decay curve. That's why when we buy further out in time and use the income methods we talk about to sell closer in to start paying down that 8% risk on the position. And it's true for every stock. There are some aberrations. 95% of the time, this is what you see in any expiration. Sometimes when you have a biotech stock or you have a more volatile tech stock, that, let's say, has earnings coming out January 7th, for example. The near-term January expiration that would be most affected by that, so it'd be the January 12th expiration, that premium might be double, and the annualized return might be double of what you're seeing on January 5th and December 29th. Yeah, double what you'd see on December 29th, maybe triple of what you'd see on December 22nd, because this is the option that would be affected by the earnings coming out January 7th, where those next three wouldn't. That happens from time to time. It's very rare, but not rare so much, but it does just happen around earnings when you have a biotech that has one of those phase 2 or phase 3 positions. One more illustration thought on this. So we've talked about what? We've talked about the time decay curve. Forcing an ideal size trade is kind of obvious. That's why the search is set there to control the risk to single digits. Our preferred default screen. You, of course, can make adjustments to that. But that default screen we were looking at, this is where 90 to 95% of our positions that are shown in the Fusion portfolio, David, at Radioactive Trading are coming in. The at the money bell curve. Why are we buying in the money? Well, it's because we want to pay the less extrinsic value. We don't want to be buying right at the money. That's where we want to be selling using the income methods. Most of the income methods. We want to be buying on the outside wings. But if the out of the money put, lower strike, has the same extrinsic value as the in the money put, why wouldn't I pay for cheaper? And that's because you get what you pay for. Let's follow this path here. Take our Shopify position and stay with it. And we're going to go right to the search by symbol tool. This is going to show me the various strikes for my selected expiration out in time with the risk factor involved. So here is our January 90 put with the preferred risk we had around 8.4%. This one's not too bad. The 6.5% with the 95. It's a little bit deeper in the money. You'd have to have more of a positive outlook, stronger bullish expectation, David. But this might still fit our preferred concept. Let's take a look if it does here. I'm going to focus just on time value real quick. I'm sorry, I said time value. I meant range in the money. I don't have it selected as my default here. So let me add that in the money range. Percent. Oh, I did have it. I'm sorry. Oh, it's not. I want to change my order. That's what I meant to do. My apologies, David. So let me change my column order. I want the percent in or out of the money now next to our percent maximum risk. Fantastic. It's outside of the range. As I mentioned, we want to stay less than 20% in the money in most cases. This is really close at 23.7, but might be a little bit outside of the wings. What we're looking at here is that here's our preferred one highlighted naturally that came up on the default search. Usually when I'm selecting a married put, we have other discussions on this, and we may tackle this at a later date. Or I can point you to other references where I've done it. But when I'm evaluating a position from the search, I will look at different expiration dates within the range. Hey, January 399 days came up. What other expirations do I have? Do I have a 280 days, September, fantastic. Do I have a June? What expiration date do I have for this particular stock that's matching that minimum 150 days? So I might take a look at some of these other expirations, June or July or September, just to compare the risks. Let's say July. Let's see what we've got. We know the 90 put was at 8.5%. Okay, so here it is. This is what I typically call when I'm evaluating, because I switched the expiration date. I'm still in the preferred range, still on the right side of the time decay curve. And I know where my 90 strike is. I don't want to be too deep in the money. But here, I can take a 10% risk. I'm sorry, I can take a 7.2% risk by only going 10% of the money with the 85 for 217 days out. That's a little bit more cost effective, but I'm not giving myself the more time. I would be paying the higher annualized cost in this situation. But when I go to this search by symbol tool, I see the preferred one that was likely on the married put screen. That's the one I most likely would have selected. But I'll go to the search by symbol tool and I'll take a look here and I'll compare what I call usually, just by default, just by the structure of the trade, how it happens. I'm going to take a look at the three bears. What's the difference of the three bears? Well, this is a little bit high risk, 9.6%. It's outside of my preferred range, not only of 8.5% on the default search, but my personal preference. I don't usually try to take a risk of higher than 7.5% unless market conditions, volatility include that I have to do that if I like the stock and I'm bullish on it after a downturn. Then I might take a 9.5% risk. So this one's a little too risky. Still in the money, that's good. Good delta, don't really pay attention to that too much, but the risk is a little bit too much, too high of a risk. This one here, the 90 strike, it's what I would have bought for January 400 days out, but I'm only giving myself 217 days out, about half the time. It's got a great risk of only 5.2%, but it's 17% in the money. When I'm selecting a strike, is a strike I feel that the stock is likely to reach, like I mentioned, in the next 20 to 40 to maybe 60 days. And not because I'm looking to close the position, David, but that's the best time to start doing the income methods or the bullish income methods. If I'm wrong and it goes the other way, hey, I'll use some of the bearish income methods discussed in the blueprint. But this one, great risk. Too deep in the money. Expectancy of profit might be a little bit too low for 270 days. For 400 days, I might be okay with that. And then this one, just right. 7.2% risk, right in the wheelhouse of what I look for of less than 7.5. I'm only about 10% in the money. I'm bullish. This is a bullish strategy with great protection in place, the proper protection in place, as you mentioned. And that's my three bears. That's what I might consider when making a selection. Normally, I'm analyzing the one that comes right up on the search that matches what I want to see, my stock chart, my preferred voodoo, we might say, for technicals and trends and everything. But I'll always come to the search by symbol before opening a new trade and posting it in Fusion, because I usually end up just comparing the three bears. What's a good risk, but too deep in the money? What's too high of a risk, but still slightly in the money? That should be the X, I'm sorry. And what is just about right for me? Personal preference, but that's another tool that I like to use before I finally enter the trade on the position. And yes, I may look at the different expiration date depending on market outlook and other aspects. Why I really wanted to come to this page is, remember when we were looking, let's go back to January, one moment. Give you a little bit of insight in my thought process there, but I'm sorry, I did go down the rabbit hole. What I really wanted to show you is this. Excuse me. I had mentioned we were looking at our 90 put here, and there's the open interest and implied volatility range. I'm going to add a couple other columns here very quickly. Now, I think I already have it. I already have what I want there. I was going to do it a different way with time value, but I don't think I need to. Assuming the ask price of the put, David, that January 90 we were evaluating initially, 21.40, so that would put our cost at 98.22. We're guaranteed to get 90 back. So I have an $8.22 risk, which is 8.4% of my total cost basis. Monetary time value of $8 or less than $8 is here, the January 65. This is all time value. There's no intrinsic. $13 or so of this 21.03 or 21.40 price is intrinsic. I'm guaranteed to get that back. I'm risking the extrinsic value of 8.22. Why am I not buying the cheaper put at 7.55? Almost 3 times less than the $21. And it's because the insurance doesn't kick in until the stock drops to 65. Now I'm risking 23.5% as opposed to 8.5%. That's not where I want to be. I want to be in single digits, controlled risk on the trade. Why is that important? Well, let's say that even though I might take an 8% risk, David, on these positions, maybe even a 9% risk if volatility is high, I'm not going to allow myself to take the full risk in most situations. I have done a couple times recently, but I'd reduce the risk down to 2 or 3%, and then the stock just tanked. And rather than try to stay in it and repair it for the next 80 to 90 to 100 days, if I thought it was going to recover, 2 of them did actually with a recent run, I just closed them out and took the 1 or 2% loss. But let's say, on average, I'm looking about at 8.5 here risk that we're looking with our January 90 put at the ask price. So let's say that on average, I'm only going to allow half of that to take place. If the stock moves against me, doesn't do what I want in the first 40 to 60 to 90 days, I close out of the position and only take a loss of, let's say 4%, 4.2% or so. But at the same time, on my other positions, they're doing what I want. I'm getting income methods, and the goal is to make a realized or unrealized return, realized using the income methods or unrealized return by growth in the stock every 20 to 30 days, about 1 to 1.5%. That's what we typically get. Ernie sees about a 17% return in his portfolio in his married put positions. Why is it important here, focusing on that value of 8.5 single-digit risk versus 23.5% using the cheaper put to save money? Let's go ahead. Let's go to RadioActiveTrading.com. I'm going to go to the Resources tab, and we're going to take a look at the Trade Simulator tool. Now, what this tool does is it allows us to put in some simple metrics. For a strategy I'd be using in my portfolio, what is my target return when I have a winning trade? What is the loss limit I'm willing to take if a stock moves against me or trade moves against me? What is my win ratio, probability of wins and losers? What is my starting cash amount? And how much of that cash am I allocating to each individual trade? This default we're looking at, I'm targeting a 10% gain on my winners. I'm going to cut my losses to 10%. I got a 50-50 win ratio. I'm going to start out with $10,000. I'm going to put $5,000 into 2 trades. Now, what this tool does is it takes a coin, David, flips it 100 times. Heads we win, tails we lose. And it runs the iteration through 100 flips to see what are your expectations of potential high value with a string of winners, a low value over time, hey, we're down about 50% here, and an ending amount with this kind of track record. Why is this a default? Well, essentially, this is where beginners start when they're looking to trade stocks. Hey, you go in with a goal to make 10%, buy a stock, you think it's going to go up in price, you're looking to make 10% on the winners. You're going to follow the William O'Neill rule, maybe close it at 7 or 8%, but just buying stock, holding and hoping, what do we know? Yeah, different market conditions, things like that. Over time, you're probably looking at a 50-50 win-loss ratio, despite whatever metrics you're using or things of that nature. So what do we see? Okay, 48 to 52 had more losers than winners. We're down about 27, 23% at the end of the day. 100 trades. There we go. Where do we see a profit? Got to be right, 57% of the time. You're still going to see a pretty big drawdown. I'm going to try to get to, it's random every time, so just bear with me 1 second. There's closer to 50-50. We're still down about 20%. In the money covered calls trading, deep in the money covered calls, high probability, using a 2-week out, maybe a monthly position. Hey, let's go ahead and target return for an in the money 2-week out covered call of about 1.2, 1.5%. We're going to follow that William O'Neill rule. And we're only going to try to put our stops, we know how well those work, right? We're going to put our stops at, let's say, 7 or 8%. We're only going to allow a loss of 7%. Stock moves down 10%. Hey, we keep that 1 or 2% premium we took in. Hey, we're only down about 8%. It drops 7%. We might only be down 6. Let's use 7. Hey, but we're going in the money now. So we probably have a good probability of getting assigned and earning that 1.2%, maybe 70, maybe 75%. I'm not going to say 80 or 85 because I'd be too deep in the money with my covered calls and I wouldn't be getting that 1 to 2%. Hey, it's a capital intensive strategy. We're start out with $10,000. Probably be better to start off with 20 or 30, but keep the same amount. Allocate 50% to each. I'm sorry. Strike that, reverse it. You want the loss. We're going to put in 30%. Okay. Probability of a loss is 30%. Probability of success 70% or higher. 70-30. I hit my target for my probability. Didn't get too high, started off with a loss right away, but that only took the account down to 96.50, trying to control risk. But long term, that's not enough. I'm still down about 50%, 48%. I got to do better. 75%. Nope. Still not cutting it. I either have to lower this, say, hey, I'm not going to cut it with 7% winners. I'm sorry. Cutting it to 7% losers. Let me take that down to 5 with my 70% probability. Is that going to get me profitable? Nope. So I'm going to need to be right. I'm going to have to cut my losses to only 3% in this case, which makes sense. I'm making 1.2. We're winning 7 out of 10 times. Control risk to 3. Let's be right, 70. There we are. We have a small profit of 5 per, not even 5%. Sorry. What's happening here? If I'm limiting my losses with a stop to when the stock falls and I'm losing 3% on the position, I'm not having a 74, 75% success rate. I'm not having that. If I lower this down to 3%, I'm going to be closing more trades that ended up being winners. I'm probably only going to be at a 50 or 60, maybe a 65 if I'm lucky percent win ratio, and that's going to wipe it out. Yes, David, I wasn't going to get to that, but David asked, wouldn't the percent invested per trade affect this? Absolutely, and that relates to that second level of protection I mentioned in the married put. I just want to use the same investment amount and same invested because we're talking about covered call position, stock positions initially, and then we're going to look at the married put in that case to see how it works because it's capital intensive. But I want to keep the same metrics here with $10,000 just so it's easier to digest. Typically, for credit spreads and things like that, I allocate only 10 or 15% of my portfolio, and I found the sweet spot is about 33%. I open about 3, maybe 4 trades with that. You hear about the Kelly criterion, about the 20%. So if at $100,000, I might be closer to that 20% for my covered calls that married put. I'm only putting $20,000 into each covered call or each married put in that scenario. Absolutely, that does help. But we want to keep the same example here going so that we can illustrate the importance, not only of single-digit risks, but also the benefits. Now, you can agree and say, you can argue and say, okay, you know what, Mike, I'm better at that. I'm going to have a 75% win ratio. Yeah, 82, you get closer to what you'd expect with conservative in-the-money covered calls, around a 24% return. Around 1.5% to 2% per month, trading 2-week out covered calls, 100 trades, 82% success rate to probably get to what you want for the target return for covered calls. It's not at 70. It's not at 75% win ratio. Of course, this was at the 3%. If I take it down to 7, again, yeah, we're going to be back up to about 85, I think it is. I think that's the sweet spot. I might just do that. Let's just put it at 20 and see what we get. Close. 83, that's close. It's really around 87. And I'm going to spare the conversation on this, but it happens the same way with the credit spreads. We have other videos on that, but where you really need to control the loss to 50%. Because if you allow the losses to go up to 60, 70, or 80%, that's of the maximum risk, the difference in strike prices minus the net credit. It's drastic. You can have an 85% win ratio and still be losing money. You have to control the risks. Now, the married put, what did we talk about? I talked about how I'm looking at positions to gain 1.5%, maybe 2%, but really around 1.5%. So let's say that I'm in these positions for about 4 months on average. So on average, I'm going to make about a 6.5% return. I'm sorry, folks. There you go. All right. And I am taking a risk of 8% or so, David. But remember, I can navigate out of that married put. I might be doing income methods. So I'm going to control my risk. So let's just say 4.7%. Half of that 9.5 maximum we'd allow, 4.75 or so. And oops, I'm going to keep my 50% invested per trade. And I'm going to put my win-loss ratio at 50. I'm wrong more often than right. And after 100 trades, I'm still up 13%. Okay? I have a losing track record. Same allocation, same starting basis we looked at for just buying stock, trying to target a 10% return, 10% loss, right 50% of the time. Covered call, in the money, conservative, even going with a target return of 1.2, 1.5%, controlling risk to 4%, 5%, 6%, 7%. I wasn't making money with a 75, 70% win ratio. I needed to be up to 83, 84, 85%. Controlling risk. Starting, one of the main points we talked about the 3 core principles in a little bit more in depth, David. The structure of the married put itself, what is it doing? It's doing what every guru for the past 90 to 100 years has been saying about how to profit in the stock market or investing. Cut your losers short, let the winners run. That falls into the fist category, forcing an ideal size trade. You've put yourself in a structure where if the stock moves up 8, 10, or 12%, you're still making 50% of that, even without the income methods, without selling the calls, without using the second instrument that you have in your arsenal, the put option. It's not a wasting asset necessarily, done in the proper structure. You saw that. As a stock moves up and down, you can manipulate that put to lower your cost basis, lower your risk. It's a second working asset in your favor. And what else am I doing here? I'm controlling risk guaranteed, not like a stop order, not like a trailing stop where if the market gaps down, hey, you said, you know it, you've done it, trades, stocks, spreads, positions. Hey, I want to close this position. I'm putting an order in my broker to close it if my stock falls 5%. Stock gaps down 25% overnight for some news that came out that wasn't even related to a known event with an unknown outcome. It wasn't earnings or anything else. Some bad news came out. Stocks falls 15 to 20%. Where are you closed? At the 5% loss you targeted? No, at whatever the market can give you. You're down 15 to 20%. You know how that's going to affect your prices and your total outcome here just by looking at this tool for the last 10 minutes. Guaranteed controlled risk. It can't be violated. You control it, not the market makers, not an automatic order that's filled because the stock fell 12% and you wanted to be stopped out at 3. You control the percentage at risk. And as I said, not allowing to take full loss, having the ability to close the position, maybe only 4.75% loss, even with a 50-50 win ratio, and leaving the upside open so you can see more of those gains in the directions you want, and having 13 income methods to boot. 6% return on the winners, 4.7 controlled risk on the losers, even with a win ratio of 50%, even with a slightly losing track record, still profiting on the position, and the drawdown is absolutely negligible. That's the proper structure in action. Are these numbers realistic? Actually, they're worse. I mean, what I mean by that is mine's worse. A little bit better, but a little bit worse. Ernie's is better. So I'm just going to go in the track record, not logged into a Fusion account. It's just going to show me the basic numbers. So over 87 positions. Okay, so 87 married puts open, 51% win ratio, making 6.3% when I'm right, 5.1% when I'm wrong. Starting off with $10,000, 100 random trades, allocating 50% of each. This is the expectation over time using those numbers. Starting with $10,000 for the first investment. I think that's 100% invested, not the 50%. So why my drawdown isn't so bad. Now I'm trading with more than $10,000 with this, and this represents 45 to 55% of my total portfolio, David. But this is my track record from the recorded positions in the Fusion subscription. Ernie's is a little bit better. Now I've got about a 59% win ratio. That's in my favor. But I think I cut the winners too short. Why do I say that if I'm hitting my goals? Well, Ernie's averaging a 10.5% gains on his winners and 5.2% on his losers, 57% win ratio. And you can see how that expectation pans out. 101 total positions. That's why the structure is there. That's why the controlled risk is in place. That's why this is the proper controlled risk and why we advocate the blueprint so much, especially for investors who are just getting into retirement, who are still trading their own accounts and want to remain active, but aren't taking in disposable income anymore. Need to protect that against market volatility, the unknown going forward. Yeah, we're expecting rate hike cuts. How is that going to affect the market? Could actually lead to a different inflation or deflation, which will cause more volatility in the market. How do we smooth that out with the bulk of our portfolio, control risk, and stack the market odds in our favor? The proper structure, following the 3 core principles of radioactive trading, keeping losses to single digits, and we just saw why that's so important, how that could affect the position, and still, even though I'm paying for the risk, how can it be profitable with even minor assumptions, minor goals, minor targets, because you're doing the one thing that's been advocated by every guru for the past 90 years. They say cut your losers short and let your winners run. Do you want to leave that up to market orders, stop orders, or trailing stops? Why not do the guarantee? Guarantee to put yourself in a position that forces an ideal size trade, guarantees only single-digit risks with the potential to leave the upside open to, if you just entered 5 or 6 married puts in the next 2 months and something unfortunate happened where you couldn't watch the market for whatever reason. We don't want to talk about that. We don't want to see that. But something happens where you can't watch the market. You don't necessarily have to worry about it, because even if every stock collapsed of those 6 and dropped down to $2 per share from when you bought it, in the proper structure, each position would have only been an 8% risk, but you would have used that second layer of protection discussed in the blueprint. So each of those 6 positions might have only lost 1.5% to 2% of your portfolio. You might be only down 12%. Would you have that same confidence if you opened up a covered call 6 months out in time? Bought the stock, sold a 6-month out call, and said, yeah, I don't need to watch it for 6 months. Or out of the money naked puts. Would you have that same confidence? Probably not. You'd probably want some extra protection in the portfolio, or the best way, the direct protection, as I mentioned, that we advocate for and is discussed in the blueprint as well. Okay, so a lot of discussion, a lot of detail there. I might break that up into 2 or 3 different sections there, but that's why the strike and the date we select when using the preferred protected put. Why are we going far out in time? Why are we going at least 150, 180 days out in time and slightly in the money where we're seeing higher cost? Because it's not really higher cost. It's not a higher annualized cost compared to shorter term cheap puts. We're going with the ATM Bell Curve where we're only risking the single digits, whereas going out of the money and just paying the $7.50, $8, but being 10 to 12 points below the current stock price, stock has to fall 10 to 12 points before the insurance kicks in, and you can still lose that $7.40, $7.50 of time premium. That's the proper structure. And then we look to implement the income methods. All right, so David, I hope that helps answer your question. Excuse me, folks. And one of the reasons, didn't see any other questions that have come in, but one of the reasons why I spent so much time on that is, and you'll see it pop up tomorrow, I'm only going to tell you to buy the blueprint. I'm not going to say, yeah, you can go to Radioactive Trading, look at the products, you can read more about the blueprint, you can view the table of contents, you can listen to the first chapter for free. I don't want you to buy the blueprint today. I don't want you to buy the blueprint tomorrow. I want you to wait, because in the next day or two, probably by Sunday or Saturday evening, that's when we're going to launch our end of the year promotion for the blueprint. We don't discount the price. However, we're going to have a series of bonuses available, and we're going to have extra free time to power options, extra sessions with myself or Ernie. We do the end of the year promotion every year for the blueprint. We're going to launch that in the next day or two, and you'll see emails about that. So I don't want you to even buy it right now, even though we illustrated how important it is for the protection, how it's better than using a trailing stop or a stop order. It's a guaranteed exit. It forces you into the ideal size trade. It sets you in a position that follows what every guru has said to be successful in investing and in the market. You're forced into that structure, and it's guaranteed. And then you have 12 different fun ways to generate income off of that position and increase those potential monthly returns I talked about of the 1 to 1.5% unrealized gains in the strategy. But I don't want you to buy it today. I don't want you to buy it tomorrow. Look at it, take a look, listen to the first chapter for free, view the table of contents. But in the next 24 to 30 hours or so, you'll receive an email. We're going to launch the end of year promotion through December 31st. That's when I want you to consider picking it up. I'll even have these videos out before then. We'll have them out tomorrow, I think, probably before the end of year promotion turns on.